Good afternoon, everyone, and welcome. My name is Chad Hilliard. I'm the Vice President of Corporate Development here at the Center for Healthcare Solutions. And welcome to today's webinar, The Revenue Cycle Scorecard, the Pathway to Optimal Performance. Today's session is brought to you in partnership by our corporate partner, Revenue Cycle Solutions. Our presenters today are Mike Evans. Mike is the Managing Principal at Revenue Cycle Solutions. Dan Terry. Dan is also a Managing Principal at Revenue Cycle Solutions. And Craig Trout. Craig is a Vice President at Revenue Cycle Solutions. There will be a Q&A following today's session. Any questions you have can be submitted through the chat or the Q&A section at any time during the presentation, and we will get to those at the end of today's presentation. At this time, I'd like to turn it over to Mike, Dan, and Craig to begin today's session. Welcome, men.
Thank you, Chad. We appreciate your introduction, and here are our dynamic presenters. We appreciate the introduction, and we're excited to talk about the revenue cycle, its importance to the fiscal health of our organization, particularly if you can develop a comprehensive scorecard that keeps track of all the important metrics within all the appropriate revenue cycle departments. I think once you have that in place, then you have a pretty good idea of how your organization is doing, at least through the revenue cycle. Everyone likes to keep score, so that's going to be the primary focus of today's session. How to develop that scorecard, what it means, what's important, and so on. So to kick us off, I'm going to turn things over to Craig Trout, who's going to kind of describe the environment that we are all involved in and how difficult it is, and some important ways that banks and rating agencies view our industry. Craig?
So let's take a high-level overview of the environment today. Most of you are experiencing declining volumes and patient activity moving to ambulatory and office settings, even subacute provider settings. You're all dealing with staffing wage increase requirements and agency expenses, primarily on the nursing side, but in general across the board for all technical expertise. You're continuing to struggle with supply chain inflation. Much of that started during the pandemic, but has continued and is a major issue for many healthcare organizations. At the same time, these are all occurring, at Medicare and medical assistance rate increases continue to be less than your cost increases. And finally, many of you have employed physicians and employed physician organizations, and you're continuing to experience annual losses per FTE. The national average is in excess of $150,000 per physician FTE today. So let's take a look at the two key metrics that bond rating agencies and lenders tend to focus on. And from a CFO perspective, these are two of the key metrics that we need to pay attention to. The first is the debt service coverage ratio, which is a capital structure ratio. Note that the numerator includes the excess of deficit of revenues over expenses and incorporates both the operating margin or deficit that the hospital is experiencing, as well as investment income and non-operating gains. Typically, the debt service coverage ratio is a covenant with a minimum target included in the tax-exempt bond issues or the bank loans that you currently have on your balance sheet. And while this is a required minimum target, there are some pretty significant, quote, penalties, end quote, if you don't hit these debt service coverage covenant minimums. First of all, if you don't meet them on a routine basis, you can be deemed to be in technical default. Technical default means that while you are paying your principal and interest payments on a timely basis, you are not meeting the debt service coverage ratio covenant target, and therefore you're deemed to be in technical default. Technical default is a real problem for healthcare organizations in that it can lead to a possible qualified independent audit opinion, which is something that we all want to try to avoid. The other key metric is days cash on hand from all sources. This includes not only your working capital, but all of your unrestricted board designated investments. And as we all know, cash is king. So what can you do to improve these two key metrics? You can certainly work on staffing reductions and Many of you likely already have programs in place to try to deal with this issue. You can try to resolve or improve supply chain and enhance cost efficiency. As we all know, that oftentimes includes trying to deal with physician preferences, so that can be a challenge and be perhaps a more longer term issue to deal with. We can try to renegotiate our payer contracts. That's not easy. And lastly, you can work on revenue cycle improvements. And an investment banker contact of mine recently said to me, we view revenue cycle improvements as the sweet spot of opportunity because it's an area in which the health system or the hospitals can reduce or eliminate the leakage in their existing book of business and can be, in some cases, easier than some of the prior ones that I have on this particular slide. Now, I also want to mention that today's presentation focuses exclusively on hospital KPIs, but recognize that there are just as many KPIs, although they're going to be somewhat different, that would be applicable to your physician practice organization. So what can revenue cycle improvement do for these key ratios? Well, first of all, on the debt service coverage ratio, you can improve your excess of revenues over expenses by improving your realization rate, reducing bad debts, and other administrative write-offs. For days cash on hand, I think it speaks for itself. You can certainly improve cash from a cash acceleration perspective, but also you need to recognize you may be able to reduce total expenses. So you're improving both the numerator and the denominator. And when I say total expenses, I'm really talking about those expenses related to the revenue cycle.
All right, thanks, Craig, for that high-level overview. That was very helpful. Now we're going to start to drill down into the revenue cycle itself and the KPI scorecard. I think, as we all would probably agree, the revenue cycle is a complicated series of interconnected financial events that occur within our organizations, and it's important to have metrics for all areas, where possible, all areas of the revenue cycle, because in our world right now, it's very analytical, and the numbers don't lie. Okay, so what we have here are some key points that we'd like you to follow when establishing your scorecard. First of all, KPI industry metrics are incredibly important because you want to be able to compare apples to apples when you're looking at your scorecard as compared to what the industry benchmarks are. And don't make up your own. I think sometimes it might be easy to invent some KPIs for your own purposes, but that's not going to help you compare yourselves to others in the organization, others in the industry. We suggest you follow the exact formula provided. Here's an example, DNFB, discharge not final billed. Many might capture DNFB in the legacy system only and omit the DNFB from the edit billing system. So you want to be able to capture both in that regard. Don't be afraid to, use most accurate information regardless of system location. Here we're suggesting that we don't want you to be held hostage by your IT system or any other particular source. Most often, the information resides in your organization somewhere. Now, most of it's probably in your IT system, but I think it's important to compile all that information. And don't be afraid to replicate information that may already be available on other reports. For instance, you may have KPIs for each of your departments, which is a good thing. But what you want to do is collect and compile that information on your scorecard so it's in one place. And we'll show you some examples going forward as to what that can look like for you, for your organization. And importantly, you want to include the revenue cycle metrics for each stakeholder department. And we'll talk a little bit later about the importance of the Revenue Cycle Steering Committee, because this is really where accountability for results can take place. The scorecard can be the basis for information sharing, accountability, and revenue cycle performance. So this is something that is very key going forward. Here are some industry sources for best practice metrics. I'm not going to go through them all, but they're all very credible sources for compiling metrics. HFMA, for instance, it can provide information across the entire revenue cycle, but for PFS in particular, HEMA for health information management, and IT can look to HIMSS for sources of information. The reason why you want to look at these organizations is that they stay current with current practices, and they update their information and are able to update the benchmarks that you need to use. So the revenue cycle departments to monitor. These are typically what we monitor in all the organizations that we work with: patient access, revenue integrity, case management, clinical documentation integrity, health information management, patient financial services, and cash application. There should be metrics in your organization for each one of these, because if you have those and you're able to have them all work together because they do impact each other, then I think that can potentially lead to margin improvement, cash acceleration, expense reduction, certainly process improvement. You want to take a look at these to see where can improvements be made. Do I need to change something? Does my department need to relate in a better way to another department within the revenue cycle? And last but not least, hopefully this all leads to, and most importantly, a better patient experience. So with that, I'm going to turn it over to Dan Theory, who's really going to delve into the metrics for each important area within the revenue cycle. Dan?
Okay, thank you, Mike. Good afternoon, everyone. What I'm going to go through in the next several slides is an actual breakdown of an actual rev cycle scorecard that we use for many of our hospital clients across the country. This particular one is just a sample. And before I begin, just to kind of lay out the format, the metric, the primary area is going to be in the upper left-hand corner. We'll have a best practice metric designated there if one is available. On the very last slide I show you, this 13-month rolling average will make more sense just from a visualization standpoint. But for now, we just want to let you know that this data is captured month over month and with an overall 13-month rolling average. And the last column there is actual. It's kind of mocked up information just so we can compare and contrast as we go through these various examples. So obviously, the first segment of any good revenue cycle scorecard starts with revenue, of course. Top line revenue, gross revenue is the first item on any KPI scorecard. Many things are derived from gross revenue. So obviously, we recommend that being captured month over month in terms of gross revenue. Also, the 3-month daily average, that's important because, as many of you know, 3-month daily average is used to calculate many KPI metrics throughout this scorecard. So you want to grab that 3-month daily average and maintain that month over month. Late charges. This is a great place to measure those charges that are posted to a patient's account for beyond 48 hours from discharge. And it lets the organization know what issues there may be relative to late charge posting. And in instances of really high late charge posting rates, there's typically lost charges associated with that as well. But just in this quick example, you could see a best practice metric of it shouldn't be greater than 2% of total charges. In this particular example, hospital has 2.1%. So pretty good performance, but not quite at or below the best practice measure. Following that through, we're looking at net patient revenue. I'm sorry, Mike.
Sorry.
Net patient revenue as well as adjusted net patient revenue, and then the 3-month daily average on that one as well. So at a glance, you could readily see the gross versus net relationship from a revenue perspective. This next area gets right into the cash collections. Craig was mentioning earlier, the days cash on hand and from a cash acceleration standpoint, an organization needs adequate days cash on hand to function properly, to not have any interruptions in their overall operation. So it's a key piece. and one that we recommend is monitored closely. And in this instance, we'll be looking at AR payments month over month. We'll make any small adjustments to that for things that are unposted, unapplied. You can see there in that example. And then in our example hospital, we could see $48 million in cash posted for a given month. I'm going to skip over those next three because they're really optional for those organizations that have quarterly and perhaps monthly, quarterly goals in place. And it just basically allows you to look at fiscal year to date totals and more specifically totals relative to goal. So if you have that, I would encourage you to include that in your KPIs as well, just as I mentioned. Payments as a percentage of gross revenue. We get to see, a lot of variation in this number of this particular example hospital. You could see they're being paid at 17% or 17 cents on the cash on the gross dollar. And we also track payments as a percentage of adjusted net patient revenue. This should be at 100% if the calculation's right. And you can see this particular example hospital running a 13-month average is at 101%. So I would say their NPR adjustments are spot on. If it's significantly less or greater than that, you might want to look at some of your net patient revenue adjustment factors that might be contributing to that. So again, that should be at about 100%. Point of service payments. These are becoming more and more important. They represent a larger and larger portion of a facility's contracted payment amount. No longer is it just a simple copay for $50, $100. Many of these point of service collection amounts are in the thousands of dollars. And what's most important about those is those are a part of your negotiated contracted payment, and they're very important to secure, preferably prior to service or at point of service wherever possible. Okay. Moving on, I know Mike mentioned earlier, just as sticking to the calculations provided. This is another piece of the scorecard related to cash acceleration, titled "Discharge Not Final Billed." Places vary a bit, but essentially are made up of the following three components. You could see on the first line here, the bill hold day set at 4. Most hospitals have what they call a minimum bill hold day period, and 4 is pretty typical for what we're used to seeing. That could be adjusted upward or downward depending upon how effective you're managing your late charge postings and your coding. But the minimum bill hold day period is intended to allow the organization time to review the documentation, assign codes and modifiers to the account, but also allow ample time for the charges from various departments throughout the house to post charges to that account. So that was the intent of the minimum bill hold day. The second bracket here are for those claims that go beyond that 4-day hold period, but are still holding for something critical to the submission of the claim, such as, maybe there's not a primary diagnosis assigned yet, or a primary procedure, or it's missing a key charge. So, first bucket is a minimum 4 days. Second bucket is what is still holding beyond the 4 days for key critical information. And then the third bucket is the unbilled claims that drop out of your legacy system but are still being held and edited within your bill editing, your bill scrubbing system, if you will. All of which make up what we title discharge not final billed, all of which should be measured by the organization as instances where the patient has been discharged but the claim has not been submitted. In this example, you could see a 5-day best practice benchmark compared to this example organization's 7.7 days. So, from a cash acceleration standpoint, and we as consultants, we would identify this with the organization as roughly a 2.7, 3-day opportunity to get the claims out the door quicker and enjoy that cash acceleration benefit. Mike mentioned earlier, it's important, for a good KPI scorecard to encompass all rev cycle departments, and there are measurements in each of them. These ones happen to be access. The first two are key critical and have a direct impact on claim denials for most organizations. That is insurance verification rate. The benchmark metric for that is 98%. So 98% of instances for insurance verification, it should be done prior to date of service or at time of service, and that best practice benchmarks at 98. And you can see this example organization is at 97.5 and performing very well in that respect. Registration accuracy. This is another important metric to monitor, because without the accuracy, a lot of these have denials, it impacts with denied claims, and that's one of the largest areas of opportunity, from the work we do. There's usually a significant amount or a higher than necessary amount being denied and reimbursements being lost. So those first insurance verification and reg accuracy are both important from a cash excel and a denial standpoint. The second two are really patient satisfiers or dissatisfiers, depending upon how your folks are performing. The average wait time, that's the amount of time patients are waiting before they're called up to registration. Average reg time at 3.5 minutes, that's the actual time. You could see they're performing pretty well at 3.3. So these are some examples of access metrics that you might want to measure for your organization. Next two areas are HIM. I spoke earlier of the discharge not final billed. I believe the overall metric was at 5 days. Well, a component within that 5 days is HIM or medical records. And if we were to just look at accounts requiring assignment of a code, that metric is set at 2 days. That best practice metric is set at 2 days. So if HIM, we were looking at these accounts with blinders on just with regards to code assignment, they would understand that they have on average 2 days to have that code assigned. In this particular example, they're performing at 4 days, so that there's a 2-day opportunity there potentially to code those a little quicker. I just want to make mention on HIM in particular. Some organizations of recent have deliberately slowed that time to code by 1 day. And what they've done is initiated a quality assurance practice in there that takes an extra day to check, but in their view is well worth it. And this is especially true on those higher acuity and higher charge claims. CDI, this is an initiative, clinical documentation integrity. It's usually it's an initiative that most facilities have taken on over the last 10 years. Gross realization rate is simply the difference between what the initial code would have optimized to from a DRG perspective versus what it ended up being post CDI review. And a lot of this has to do with querying the physicians for additional information. It has to do with additional documentation. It has to do with making sure that you're capturing all of your CCs and MCCs and those items that matter and have a direct impact on the overall DRG and ultimately the case mix. Next area is patient financial services. I won't go through each of these. I'm sure most of you are familiar with this type of breakout within PFS. If we look at this from an overall AR perspective, it's comprised of in-house, DNFB, and build AR. We'll get into the build AR. Usually one of the favorite things for hospitals to look at is build AR in excess or aged in excess of 90 days. And what you're looking at here at the first level is build AR over 90 just as a total percentage. And you could see the best practice metric is set somewhere between 23 and 28%. In this example, facility is currently performing at 31. If you follow that down, there's also a view of debit AR dollars over 90, just debits only. And it's very close, but it's just another measure with the credits being taken out of the equation. Following that down further, credit balance days, you really shouldn't be carrying more than 1 day in AR equivalent in credit balances. These may seem, like an innocent area and in terms of measurement and minimal impact on the overall receivables. And in this particular case, that is true. But in some instances, these credit balance days are in excess of 5, 6, 7, and 8. And it's important to note that in many instances, credit balances are not merely refunds to be sent out to insurance companies and patients. Often they're a result of overstated contractuals and charge adjustments and a number of things that could be really masking and ultimately skewing your true AR performance. So I would encourage you, if you're not already monitoring credit balance days in this manner, to perhaps pick it up in this KPI scorecard. Clean claim rates, another area, good measurement, where we see best practice measurements here, typically between 85 and 90%. This particular example organization's currently performing at 82, 83%, which is a pretty good rate. And also, the next line down is a measurement of final denials as a percentage of net revenue. You could disregard that last line. I think there's a couple extra adjustment numbers in there, but the second to the last line I could share with the group of what we typically see and what you should look for. We're seeing, and it's not on here, but we're seeing initial denial rates typically falling between 5 and 6% of total billable. And we're seeing final denial rates, after those appeals are done and things are rebilled and the like, we're seeing that below 1%. So if that gives you some idea of what your initial versus final should be, and that's certainly worth measuring. Now we're into the avoidable write-offs, and you can skip the first 2 lines on this, but if you follow from that item 5 down to 137, you could see that these there's about 6 or 7 various denial reasons that we attribute to patient access. So some of those inpatient authorizations and notifications, that's something that patient access should be aware of and should work on up front and ultimately prevent issues with. OP authorizations, eligibility, that's verifying the insurance. That's patient access 101, that this activity should be done up front. Non-participating provider, another example of a patient access related denial, because those insurances that participate with your organization should be known. And those insurance plan codes that are available for access to select should be constantly updated. And perhaps most importantly, the access staff should be aware of which insurance plan codes are participating versus non. And that's key to know of what portion to collect up front. So you can see some other things there related to outpatient medical necessity. These are things, at least from a Medicare standpoint, that should be flagged as a Medicare, as an ABN check. Do they pass basic medical necessity? Often these are flagged up front or could be flagged up front, and money collected or at minimum an ABN issued for balance collection from the patient. So those are some examples of patient access related denials that we believe are avoidable. And again, we will be tracking these month over month with a 13-month rolling average. The bottom section there are ones we believe attributable to case management. These are becoming more and more prominent in recent years, in significant dollars, I may add. One is the inpatient Medicare 30-day readmission. It's a pretty frequent occurrence for some facilities and significant dollars. So this is our means and our recommendation by which to track those instances in terms of number of cases and related dollars. IP medical necessity, just overall, is the case, is it adequately supported from a medical necessity standpoint or not? If that's identified prior to or concurrent with the patient's stay, it's typically avoidable or significantly mitigated. But when not, it goes all the way through and is billed and ultimately denied, unfortunately, with a very difficult appeal process. The inpatient managed care 30-day readmission, pretty much following Medicare. Same scenarios, same concept, and same level of oversight and management required for that one. We got a couple here for HIM, and I won't read each of these, but you can get an idea here. Records, it's things like untimely record submission, untimely appeal. When we move into the PFS arena, there are instances when we didn't submit the claim in a timely enough fashion per the insurance contract. There are other instances when PFS is required to send out a record to supplement the claim, to support the claim, and that's not done in a timely enough fashion. Simply, in some instances, the follow-up was not adequate, was not timely enough, and time runs out on the claim we're left with no further recourse. So these are all examples, again, that we believe we title these avoidable. There are far more denials that an organization experiences, but we thought it's important from an accountability standpoint to really carve out those that we believe are avoidable per department. I mentioned at the onset, I was showing you bits and pieces of a typical scorecard, and I know you can't read this, and it's not up there for that purpose, but it is up there to show you, what a 13-month rolling average, along with all these metrics, could look like. It's tiny, but you can see that first colored area is the revenue cycle performance. The revenue performance that I had covered. The next is cash collections, followed by DNFB and patient access. But, at a glance, and that's what we love about this, the simplicity, yet the effectiveness of this type of view is really helpful. So at a glance, you can look at that best practice metric. You can look month over month to see how that particular metric is trending. You can glance at the far right column and readily know, what is our monthly average? How has this been trending? And it really gives you at a glance a great way to keep an eye on the overall performance of the rev cycle. So just wanted to give you a view of what that could look like.
Great, thanks, Dan. Very, very nice job. So where are we going from here? A while ago, a wise CFO once told me that the revenue cycle is never, ever completely fixed. So with that in mind, I think you have to pay attention to it. You have to monitor it continually to make sure you stay on top of it. The goal has always been for us here at our organization, and when we were in hospital operations, you really want to try to get every single penny of financial credit for all the clinical work you do. And I think that's one of the real responsibilities of the revenue cycle, to ensure that happens. So we want to develop KPIs with the appropriate stakeholder involvement. And in essence, that means all the departments and the key players within those departments, so that they are participating in the development. They understand what the metrics mean. And so they're kind of invested in the department's improvement. You want to update the metrics periodically as necessary, based upon those organizations that I shared earlier that stay current with the benchmark metrics. This is a key point here: establishing and maintaining accountability. This is not just a collecting and tracking exercise. This is one where the scorecard can really hold leaders accountable. And they need to be able to explain trending, why things are happening, why trends are going up, why they're going down. And we'll talk a little bit in a moment here about the purpose of the Revenue Cycle Steering Committee, where the KPI scorecard can really prove itself. We want to focus the KPIs on monthly revenue through the monthly revenue steering committee meetings. Again, where the departments can be held accountable for their performance. And what happens typically in these meetings is that department by department, they go around the table and they explain the latest, what's happening in their particular areas, and then they focus on the metrics, okay, and explain what's happening, because trending in their departments will certainly affect other departments. We recommend that the revenue cycle executive chair this meeting, if not the CFO, but the CFO should be a regular participant, so he or she knows what's going on within the revenue cycle. Share KPI results hospital-wide. What's interesting about this to me is that, you know, when there's some form of expense reduction, everybody knows about it, because people want to know, well, when am I going to be impacted? When is my department going to be impacted? And I would say lesser folks know about the importance of the revenue cycle itself. So we want to share the KPI results, I would say, hospital-wide. And I recommend that you post your monthly KPI results in the respective departments. This way, everybody has a visual of what's going on, what the trending is, and then you can talk about what improvements need to be made. Here's another key piece, because I think it's very timely. I'd say over the last probably year or two, there's been a lot of discussion about outsourcing parts of the revenue cycle or all of it. And I think a good way to measure whether you need to do that in part or in whole is through your KPI scorecard. The results speak for themselves. The numbers don't lie. So that'll give you some indication as to what you need to do. Perhaps you keep it all in-house, or perhaps you make changes. But I think it's a good way to understand your own performance. Lastly here, closely monitor revenue cycle vendors. You want to make sure you're really staying on top of their performance. You're not just outsourcing it and saying, hey, you know, good luck, have fun. You really want to make sure that they're performing. If you do so, you'll be able to optimize your expense reductions and cost savings. A couple of other points that I'd like to make relative to the importance of the revenue cycle and the scorecard itself. If you're going through any kind of an IT conversion, you know, that can result in slowdown in cash and losing some money. You want to make sure you have your revenue cycle in order. And we've talked internally about you want to brace for impact. So you want to make sure going into any conversion, your revenue cycle is fully operational. Other things to review regularly would include your CDM, your charge description master, and your payer contracts. We have found over the years that the CDM in many organizations have not been reviewed for 3, 4, 5, up to 7 years. So a lot of changes can take place during that period of time. So you want to stay on top of that. Payer contracts. We've encountered clients that don't know where they are. They're not updated. They're not reviewed regularly to make sure that you're getting paid by contract. And if you pay attention to all of this, I think you'll end up with a fully functioning revenue cycle that may result in better performance and perhaps a need to reduce expenses less. I think it can really help on all fronts. So with that, we're going to close. Chad, we'll turn it over to you for any questions.
Thanks, Mike. I was having a problem there getting back to my video there. If anybody does have some questions, feel free to submit those through the chat. Actually, there are a couple that came here through the Q&A. The first one we have, are most of your client hospitals already using a KPI scorecard at the beginning of your engagements?
I guess I could take that one. Good question. I would estimate that about 50% do have an adequate KPI scorecard that cover most of the metrics that we talked about today. Maybe about another 25% have some KPI metrics that they're monitoring and on various different and separate reports. And I would say that the remaining 25% really are not monitoring or any KPI metrics to speak of. So that would be my best estimation from my experience over the years.
Okay. Thank you, Dan. I appreciate that. How should a hospital determine which KPIs to monitor?
Mike, do you want to talk about that one? Or?
Well, I think that's one where, there are a few key critical ones within each area of the revenue cycle that you need to focus on. But as Dan shared, a comprehensive list, and within each of those, there are probably 5 to 10 that are most critical in every single area of the revenue cycle that can be addressed. So if you hone in on those as a general practice, some of the other metrics are more detail oriented. I think if you focus on the primary ones for each area, you'll be in good shape.
Excellent. Thank you, Mike. We do have another question here, and it's actually a two-parter. Are you seeing a rising number of admissions down-coded and paid as observation by Medicare managed care payers? And the second part of that is, how do you track that on your KPI?
Well, first part of that answer is yes, absolutely. I'll come back to how we're tracking that for some of our clients. I'm thinking through some of our larger health systems and larger single entities have actually put together what they call a denials prevention program, a denials prevention team, if you will. And they're activated prior to the patient coming in on some of these higher priced surgeries and services. They're activated during that time, and the whole concept there is that they're really defending those on a concurrent base, so nobody's surprised at the end with these denials. But in many instances, and observations, an age-old problem for all of us, and that is the appropriate statusing of a patient as an ops patient or a one-day admission. And that's where some folks more proactive in nature have really deployed this denials prevention team. So they're monitoring those cases concurrent, making darn sure that an observation status is appropriate, or perhaps that an inpatient admission is appropriate. We found from our experience a lot of that has to do with timing and communication between case management and admissions in the physician ordering. So in terms of measuring that activity, we do. I didn't show it to you here, but there are some breakout metrics that we can provide you with that allow case management and CDI to monitor that activity concurrent. So we're able to show you how many cases that were moved from in to ops and ops to in, and how many of those were adequately supported at the end of the day from a reimbursement standpoint.
Excellent, Dan. Thank you very much. One last question here. What are the top 3 KPIs where improvements can make the most impact the fastest?
I could break those down in a couple ways. I would say from a cash acceleration standpoint, and I mentioned it earlier, certainly from a cash excel standpoint, your point of service collections are key critical, a large and growing opportunity to really get your arms around that. Your discharge not final billed, the quicker you could get those claims coded and charges posted and out the door, you're going to benefit from that. And then last but not least would be your AR over 90. That metric, you ought to keep an eye on that, because when that's trending, north of 28-30% of your total AR, there's typically opportunity there from a cash excel standpoint. From a margin improvement standpoint, I think 2 big ones come to mind, and Mike mentioned a couple of these. And one is the CDM. I can't emphasize enough. And it's important to distinguish. Some of you might routinely get what I term a desktop CDM review, which is merely looking at your charges in the coding and the pricing and the various, that it's all linked up and there's not anything duplicated or omitted. But it doesn't do much for the linkage behind the scenes that's essential through to your pharmacy system, to your supply system, to various other service departments, and that's where so much can be lost. So CDM for sure. If you haven't done so already, I would definitely encourage you to make sure you you get a thorough review of that, and everything's up to date. The other area, again, everyone suffers from this, and that's denials. I mentioned earlier that most organizations we deal with have an initial denial rate of about 5 to 6%, but the better ones are successful in working that down to less than 1% as a final denial and what they ultimately write off. So those would be the key areas that we almost always find significant opportunities.
Okay. Thank you, Dan.
Yep.
Any other questions from our audience today? Okay, I don't have anything that's coming through the QA or the chat. At this point, I'd like to thank Mike, Craig, and Dan for this presentation today. It's been very informative. I certainly feel a little bit learned today, not knowing much about the revenue cycle myself. So thank you for that. I do appreciate. For our audience today, I will be sharing the PowerPoint that we had presented today, and also I'll be sharing Craig, Mike, and Dan's contact information as well. If you'd like to reach out to them for any further information, or if you had a question that you didn't get answered today and you want to do that privately, you can do that as well. So again, thank you today for this session, and we certainly look forward to seeing you again on our next educational session, which will be coming up next week. So thank you very much, and thank you to Mike, thank you to Craig, and thank you to Dan as well.
Thank you all.
Thanks, Chad, for organizing.
Okay.
Thanks, everyone.
Bye-bye.